One of the easiest ways to misread a multifamily deal is to judge it from the outside. The best investment is not always the prettiest building. It is the one where the numbers, the location, the tenant demand, and the financing all line up. In this video, I want to show you why serious investors do not stop at listing photos, exterior condition, or the purchase price. Because a real multifamily opportunity has to be judged by corridor strength, unit mix, rental demand, financing fit, and long-term scalability. That is where the deal either starts to make sense or starts to fall apart. If you're new here, I'm Darren from DK Wealth and Growth. And if you've been following along, you know we focus on disciplined, CMHC-eligible multifamily investing, not surface-level reactions to real estate. Stay with me until the end, because I'm going to break down the difference between a building that looks good online and a deal that actually underwrites properly. Most investors form an opinion too quickly. They see the exterior, they look at the listing photos, they glance at the price, and within a few seconds, they decide whether the deal feels interesting or not. That instinct is normal, but it is also dangerous because multifamily investing is not the same as buying a personal home. The building does not have to impress you emotionally, it has to perform financially. That is the part many investors miss. The building is only one layer. The real deal is the building plus the corridor, the tenant base, the unit mix, the financing, and the operator plan behind it. If you only judge the exterior, you may miss what is actually driving the investment. The first thing serious investors look at is corridor strength, not just the address. Not just whether the street looks clean, but what is around the asset. Where are the employment nodes? Where are the schools, hospitals, transit routes, downtown access, and major rental demand drivers? A building in the right corridor can have tenant demand that is much deeper than the exterior suggests, and a nicer looking building in the wrong corridor can still struggle if the rental demand is thin. That is why maps matter. A map can show what listing photos cannot. It can show why tenants choose that area, why vacancy may be lower, why rents may have support, and why the asset may be more durable over time. Sometimes the best part of the deal is not visible from the curb. It is visible on the map. The next layer is unit mix. This is where investors have to slow down. A building is not just 12 units, 24 units, or 48 units. The question is what those units actually are. Are they studios, 1 bedrooms, 2 bedrooms, 3 bedrooms, townhome style units, family-oriented layouts, or student-friendly layouts? That matters because unit mix determines who the tenant is, and the tenant profile determines how the building performs. A good unit mix in the wrong area can underperform, but the right unit mix in the right corridor can create stronger rental demand. That is where rent comps become important, not because projected rents should be accepted blindly, but because they help test whether the building's product actually matches what the market wants. Then comes financing fit. This is one of the most important parts of the analysis. A deal may look ordinary from the outside, but if the income, unit mix, affordability profile, operating plan, and building structure support a stronger CMHC-eligible financing path, the investment can look very different. That does not mean every deal works. It does not mean exterior issues should be ignored, but it does mean you cannot judge a multifamily opportunity properly until you understand how the financing fits the asset. Because the same building can look average visually but strong structurally. It can have ordinary photos but strong tenant demand. It can have a high purchase price but a debt structure that supports the hold. That is why serious investors underwrite the full picture before making the call. Quick question for you. When you first look at a multifamily deal, what influences you most? The exterior, the location, the price, or the projected cash flow? Drop it in the comments. I read through them and it helps shape what I break down in future videos. The final layer is scalability. A deal is not just about whether it looks acceptable today. It is about whether it helps the investor move toward a larger portfolio. Does the building create stable income? Does the corridor support long-term demand? Does the unit mix fit the tenant base? Does the financing structure preserve flexibility? Does the operator plan reduce friction? Those are the questions that matter when you're trying to scale beyond 2 or 3 properties. So the takeaway is this: the best multifamily deal is not always the one that looks the best in photos. It is the one where the corridor, the units, the tenant demand, the financing, and the execution plan all line up. That is why experienced investors do not just ask, does this building look good? They ask, Does this deal work underneath the surface? If this kind of disciplined approach to multifamily investing resonates with you, make sure you subscribe to the channel. Each week, I break down how serious investors evaluate CMHC-eligible opportunities, financing structures, and the details that are easy to miss if you only look at the surface. And if there's a topic you want me to cover next, drop it in the comments. I read through them and it helps shape future videos. If you want to explore opportunities that have already been filtered through this kind of process, you'll find links below where you can join the investor list or learn more. Thanks for watching, and I'll see you in the next video.